Welcome and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. As we approach those years we find ourselves reaching for our retirement, many of us have discovered that the way we went about doing it may not be the most effective and wealth-growing strategy that we have. Most of us follow the pension plans that our companies have offered, such as 401ks and IRAs. But why aren't they as effective as we thought they would? In fact, they've also been called perhaps disastrous. Things like excessive fees charged by mutual fund companies, and why the father of the 401k now says he would blow up the system and restart with something totally different. I'd like to welcome to the Beyond 50 radio program today a guest who has worked with more than 40,000 financial advisors since 1990 to help them build their business. And over the course of those years, she has investigated more than 450 financial products, tools, and concepts, as well as methods that were touted as sure bets for growing wealth. She is a two-time New York Times best-selling author. Their latest book, The Bank on Yourself Revolution, which is full of success stories from many satisfied people just like you. I'd like to welcome to the Beyond 50 radio program today our guest, Pamela Yellen. Pamela, thanks for being back on the program today.
It's my pleasure. Thanks for having me, Ben.
Now, this has to be one of those times with this pandemic, but boy, retirement's sure sitting there like that fruit that's just ready to drop but yield no kind of a benefit whatsoever. What do you think about what's going on this day and age?
Oh, wow. I think since what's going on right now really did expose the shortcomings of all of the traditional ways that people save and invest for retirement, starting with the fact that most people are not actually saving for retirement because when you save, you have no risk of loss. When you invest, of course, you can lose part or all of it. And I tell people, I ask this question, can you tell me with the traditional methods that you are using, your 401k, your IRA, maybe even a Roth plan or a KEO or a 403b, can you tell me what those retirement accounts are going to be worth on the day that you plan to tap into them?
No, couldn't do it.
Couldn't. You don't have a clue.
Mm-hmm.
And so you have no security throughout your life. And then if something happens like what has just happened, and we don't know how deep this could go, when something happens like what has just happened with the pandemic, you realize that you have no financial security, that the things you've been doing don't work. And I just read an article today that 50% of all Americans have already or are planning to in the very near future take money out of their retirement accounts, their 401ks and IRAs, and they are spending it on the basics. They're spending it on things like groceries, rent, and mortgage. And that points up another problem, which is that not only do most people have all of their money in the market, all of their retirement savings, and the Federal Reserve, by the way, supports that statement that I just made, most people have almost nothing outside of the Wall Street casino for retirement. So the problem, part two, is there's no safe and liquid savings. There's no emergency fund. We were only a month into the pandemic and into the shutdown when people have either lost their jobs, they had their hours cut, or they might have even been waiting on a stimulus check or unemployment check. And some of those people, as you know, are still waiting for that money. And so they had nothing. I mean, they couldn't actually even meet their rent payments within 30 days. They were in food lines because they don't have the most basic savings that are safe and liquid. And, you know, the experts always say you should have about 3 to 6 months of your household expenses in an emergency fund. Now, all the stats show that people don't have that, whether it's individuals or small businesses, they don't have that. But, it's not enough. During the last recession, people were out of a job for more than a year. Some were out of a job for more than 2 years. What if this turns into a repeat of that? What are you going to do?
And it almost seems likely that is, and at least if we do all end up going back to work, I don't know how good things are going to look anyway.
Yeah. Exactly. There's so many uncertainties and so many unknowns, and it really, the phrase I'm using is, the emperor has no clothes. We're now seeing that people don't have anything that they can really count on for retirement. They don't have anything that they can use to cover the challenges and the unexpected things that life is going to throw at us. The thing is, you can't wait until it actually throws it at us. You have to be ready ahead of time. For years, I have been advocating that advice about 3 to 6 months is ridiculous worth of, your household expenses as an emergency fund. You need at least 2 years. And if you don't have that, you don't belong in the market, period.
Yeah, it's really tough because a lot of times what we've done is we've listened to these so-called experts. And again, these are people that may give you advice, but they say the riskiest advice you could get is that you get for free. And, so we ended up following these traditions. The biggest one is the 401k. Now, let's talk about that because there are a lot of people who may be in companies. Well, I'm getting matched by the company, but there's some wrecks there just waiting to happen as well. So don't feel so great about the fact your company's matching you because that can change at any time. This could be one of those times that it probably is actually happening. But what's with the 401k and why in your book you describe even the person who created it said, this turned into an ugly mess?
Yeah, and the 401k and IRAs, that's something I've done a lot of research on. And in fact, I finished writing a new book not too long ago. The title is Rescue Your Retirement, 5 Wealth-Killing Traps of 401ks, IRAs, and Roth Plans and How to Avoid Them. And I'd even like to offer your listeners a free copy of it. You can get it for free if you go to sendthefreebook.com. That's sendthefreebook.com. But you just brought up some of the crazy things about it. First of all, you mentioned the employer match. Well, you are absolutely right that already quite a number of major companies have either cut back or most of them have stopped the 401k match. That is definitely not a given. But here's what's even more crazy, and I guarantee you that almost no one listening to this has ever heard this fact. This was a study done by the Center for Retirement Research, very well-respected organization, and they revealed that for every dollar that an employer contributes to an employee's 401k match, they pay 90 cents less in salary to men and 99 cents less to women on average. So you're only netting 1 to 10 cents on the dollar for that match. What they found is companies that don't have 401ks and aren't doing those contributions, they're paying more. You would get a higher salary. So in order for them to do your employer match, they cut the salary. It's not free money at all. But everybody thinks it is.
Just because they say it is doesn't mean that's true. So what also about the 401k seems to be a trap that we might want to take a look at and revisit?
Okay, so another one is the excessive fees. Now, some years back they did come out with a new ruling that required all the companies to be more transparent in showing the fees that they're charging in the 401ks. But even after that, almost nobody could actually tell you what their total fee per year is in their 401ks. And they spread it in really tiny print, all throughout a 16-page document. But the reality is that it's going to take something between 35 to 50% of the value of your retirement account over time. The Department of Labor calculates that if you're getting just average returns in your 401k or your IRA, and you're paying just a 1% fee a year, it's going to take 28% of your value of your account over a 35-year period. But here's the rub. Most people are paying more than 1%. And most 401ks are small companies, and the small companies charge the highest fees. They don't have the economies of scale. So they charge the highest fees, and a company called Brightscope monitors those fees, and they found a surprising number. Well, the average is closer to 2%. So remember, the Department of Labor says a 1% fee will take 28% of your account. So quick math will tell you that a 2% fee will take more than half of the value of your account. And Brightscope said they were shocked by the number of plans that were charging north of 3%. Somebody's getting rich here, but it isn't you.
Yeah, no kidding. No kidding. What are some of the other things people might want to consider before thinking about using this as an investment vehicle?
Here is something really scary. And it has to do with the fact that since they passed the Pension Protection Act back in 2006, I believe, that there was a lot of lobbying done by mutual fund companies, and what they managed to do was to make it so that employers, your employer, has protection from liability if they lose all your money or they make bad choices, as long as they automatically put your savings, put your contribution in without having to ask you every month. They just put it in, and if they automatically put it into certain default investments. Well, the default investment of choice is a target date fund. And target date funds have really come under fire for having, first of all, poor returns. There's no consistency. Let's define a target date fund. The purpose of the target date fund is so that it invests on your behalf without you having to make any decisions, and it gets more conservative in theory every year, so that as you get older and closer to your planned retirement date, you are taking less risk. Now, that's all the theory behind it. But in reality, that's not what's happening. In the last market crash, they had target date funds that were for people planning to retire in less than 2 years that dropped 40%.
Wow.
Can you imagine if you were you thought, oh yeah, they're investing it right for me, they're making sure that I'm taking less risk, and here you are less than 2 years away from what you had hoped to be your retirement date, and you just lost 40%. And every fund is different. There's no consistency. The costs of these funds are quite high, can be quite high. We found one fund that was one of the 5 largest funds that will take 31% of your account value in fees. Just for the fund fee, not even for the rest of the fees that the 401k plan and administrator charges. And here's another one. You ready for another downside?
Sure.
Okay. So taking a Roth plan, a taxable Roth plan out of the equation. If you've got, these plans are all tax deferred. How many times have we been told, oh, you want to defer your taxes, it's the most efficient way to invest, and you're going to retire in a lower tax bracket? Well, Daniel, I got news for you. Look around. Look at these, the biggest fiscal stimulus spending in history on top of runaway national debt. And it's crazy to think you're going to retire in a lower tax bracket. But if you defer your taxes, as you are in a 401k or an IRA, then, and let's say you're fortunate enough to be successful in your investing, you're only going to end up paying higher taxes on a bigger number. It makes no sense at all, and the Society of Actuaries actually says that it really, all things being equal, doesn't matter whether you do it now or later. You pay your taxes now or later. People don't even understand that's the truth about it. So they're going, oh, I want to defer. Taxes are going to be lower later. And now you can see that not only are taxes guaranteed to be higher, you have no clue what your tax rate is going to be when you're ready to start taking your money out. So we've just established that you're paying fees that are going to take 50% or more of the value of your account, and you can't even answer how much will my retirement account be worth on the day I plan to retire, and will my tax rate be when I'm in retirement? You have no clue. I'd call it a hope and pray plan.
Sounds that way. Now, I know in your book that you outline a different strategy that people want to consider here, so why don't we go ahead and talk about that for the listeners?
So you mentioned in your introduction of me that I have researched 450 different financial products and strategies, and I found that most of them weren't even worth the paper they were printed on. But I was, consulting with all of these financial advisors and so on, and they were always bringing their favorite ideas to me. And I would study them because I was looking for ways that would work better than the traditional wisdom had worked for me over the years. So finally, and this goes back to about 2001, one of my clients said to me, Pamela, have you ever heard of this? And I had not. So I started investigating this. It actually turned out I was doing it already, but not quite to that extent. And it's what I've written all my books about now, and it's what I've devoted my life to studying and understanding, and to helping other people understand what it is, because it's very misunderstood. There's a lot of misinformation about it, and I can tell you very easily and quickly how it's different from what most people know about. It is an asset it's a supercharged variation of an asset that's grown in value every single year for more than 160 years, and that includes the Great Depression. This year it grew. There was no going backwards. The 1918 Spanish flu pandemic didn't miss a step, didn't miss a beat. So it's a supercharged variation of that asset. And what it is high cash value, dividend-paying whole life insurance. It's very important that everybody hear what I said at the beginning, which is high cash value, dividend-paying whole life insurance, because most people who talk about whole life insurance talk about traditional policies that have high commissions, grow very slowly, and most financial people love to hate those policies. But there are ways to, when it involves the advisor being willing to give up a significant portion of their commission. They have to give up 50 to 70% of their commission to put these riders or options on your policy when they start the policy for you. And what that does is it cuts their commission by up to 70%, and it significantly grows your cash value. So you actually can start using it as a financial management tool within the first month. You will have cash value in the first month, and you can use it if you need to as a financial management tool. And you can use it to fund retirement. You can use it as a safe and liquid place to get cash when you need it quick, or if you want to buy a car and finance it through the plan instead of through a finance company. And we are hearing from so many people, I call it bank on yourself, because you are banking on yourself, and you're eliminating bankers from your life. Credit cards, you don't have to rely on those. You don't have to rely on Wall Street. So it allows you to save for retirement, make major purchases through the policy, have access to a safe and liquid emergency fund whenever you need it. And we are hearing all kinds of stories and getting thank yous from people who are saying, when the pandemic hit, I called the insurance company and they only asked me two questions. How much money do you want, and where do you want it sent? No applications, no pledging your firstborn, no worrying about black marks on your credit report. no worrying about any of that stuff. And the money's in your account, your checking account, within days.
Well, you can't go wrong with that, can you?
I don't know how you can.
Yeah, exactly.
But it's gotten such a bad rap, and it's like, it's insane how little people understand about things that they slavishly do, like invest everything in the market, so when something like what just happened happens, they have no recourse, they're stressed, they don't know what their financial future is going to be, they worry that the market could go down twice as far, which it could. And they have no place to get cash. Small businesses, turns out that they don't even have 30 days, worth of cash to get them through, not even 30 days. So they're laying off employees, they're getting ready to shut down their businesses, and we can't keep running our financial lives this way.
I agree with you, definitely. And you talk about, too, in your book that there are 3 keys that you can identify for business owners and other professionals where they can finish rich.
3. Oh, yes. Well, business owners and professionals, let me give you my own story.
Sure.
This goes back to the Great Recession. That's when I wrote my first book, Bank on Yourself. And I had a pretty, my company was fairly primitive at the time. But when I wrote the book, I was like, okay, I really want to take the company to the next level. If this does become a New York Times bestseller, and it did, then there's going to be a lot of people wanting to go to our website, needing information and all of that. So I thought, I'm going to do whatever it takes to take the company to the next level. So I sat down and I penciled it all out, and the figure I came up with is $500,000. I needed $500,000 to do it right. And unfortunately, it was the depths of the credit crisis, and there was no money to be loaned. And I belong to a mastermind group of successful entrepreneurs and business owners, and they were all moaning about how they had relationships with their banker where they had, played golf with the banker every week for 20 years. They had taken loans and never, ever, ever missed a payment. And their banker was saying, I'm sorry, we don't have a penny to loan. And they were like amazed that I was able to get $500,000. I had to call 3 of my insurance policies. I didn't have enough at that time in any one. So I had to call 3 different ones, but within the week, $500,000 cash was in my checking account. I knew that if I invested it in my business, I would be able to tenfold it, get at least a 10 times return on it within a couple years, which I did. And so I ended up getting all of that return. The money, I'll tell you something really exciting too, and this part doesn't matter whether you're a business owner or a non-business owner, but I was able to deduct. That's the other benefit for business owners and professionals. You can, if you're using the money for business purposes, you can deduct the interest on the loan. You can get tax write-offs for depreciation and so on, just as if you did it from a bank. And you also, there's an interesting feature on some policies. Very few policies meet all the specifications, but there's a feature called non-direct recognition loans, recognition loans. And that's just a mouthful that means when you take a loan, they don't penalize you. They actually continue to give you a guaranteed cash value increase every year. And if they pay a dividend, which these companies have for over 100 years, if they're going to credit you a dividend at the end of the year, they'll pay you the same dividend as though you had never touched a dime of it. So my money was basically working in 2 different places at the same time. It was working in my policy, continuing to earn guaranteed increases and continuing to earn dividends. I took out $500,000 and I'm investing it in my business for a tenfold plus increase, and the money in my policy is growing like I never touched a dime of it. And that to me is almost magical.
Yeah. You know, the other thing that I was intrigued by, too, is that you talk about how small business owners and others who save for retirement save what could be considered to be wealth-killing risks. Let's talk about what some of those are that aren't really widely known.
Well, the wealth-killing risks really are the taxes, the deferred taxes from saving in these qualified plans that are tax-deferred. They're the high costs. I actually show in my books and on my website, bankonyourself.com, I show how an example of if you were to put the same amount of money for 30 years into one of these types of supercharged whole life policies that pay lower commissions versus putting it into an investment account. Put $10,000 a year in every year for 30 years. At the end of 30 years, you would have paid at just 1% to the typical investment management fee, which is usually actually more than that. But if you were only paying 1%, you would have paid over $100,000 in fees. With the Bank on Yourself policy structured the way I mentioned, it's less than $10,000 that the insurance agent would get. But yet you hear these people always say, oh, the commissions are so high on these policies. They're getting rich. It's a scam. And they can guarantee you the minimum guaranteed amount you're going to have in your policy at any given time. The only thing that your investment advisor can guarantee is that they're going to get paid whether you win or lose.
Right, just like a lawyer.
Yeah.
You gotta love that. You know, I think if they changed the law where they said, well, if your lawyer goes in, if he loses, he doesn't get paid. If he wins, he does. That would really change all the advertising, I think. And people say, yeah, I think we've got a case.
Yeah.
Well, I know that you've got the money, but you don't know whether he's got the case or not. And it's really funny, you know, when you hear these kind of stories when it comes to investing, how basically what you tend to hear is, whoops, sorry, I guess I was wrong.
Right.
Yeah, but your pocket gets the money, but I missed out somehow. And I keep thinking, as we're talking about this, the Enron story. You know, here's an arrogant company that, you know, their earnings were always going up. Oh, you want to invest in Enron, it's the hottest stock, as if the employees who were into their retirement savings accounts there had a choice. And then it all just blew up in everybody's face.
Absolutely. There's just, you know, we're such an immediate gratification society. We all want to get rich overnight. And I will say right up front, you're going to say, well, Bank on Yourself is kind of starting to sound too good to be true. Well, let me tell you the downside. The downside is that it is not a get-rich-quick scheme. It's not something you can put under your pillow and wake up rich tomorrow. If you want to do that, go buy a lottery ticket. This is a steady, predictable way to grow wealth that doesn't go backwards. They invest very conservatively. They are masters at under-promising and over-delivering, unlike Wall Street.
Now, I like when you think about this program, again, because as you build on it, you were talking about how you were able to withdraw $500,000. Whereas you're going to a bank or you got credit card companies or finance companies, how we can bypass these institutions altogether. And it seems kind of unique when you think that you can reach into this particular program here that we're talking about, borrow money from yourself. You more or less get it, you know, right away. There isn't a whole lot of DNA testing and are you worthy sort of a thing. And it's kind of funny how banks have actually put themselves in a position to make us think twice about our worthiness. Are we worthy to have? It's not even your money. It's being printed out of the Federal Reserve, for crying out loud. It doesn't even really, it's an illusion. Yeah, how do you get around how people can begin to think about how do you get around with all this? And then all of a sudden, as they may move in, let's say, the direction that you're suggesting people do, then you have financial experts. And I know a couple of your top favorite ones would be like, say, Susie Orman or Dave Ramsey. I know you love those guys.
Oh, love them.
And it's funny when they come on because I remember one time we were sort of watching it, me and a couple of other people. Man, she makes a lot of sense. And I said, that woman, the only way she's making her wealth isn't by what she's flowing out of her mouth. That's all garbage. You know, she's making her wealth by selling her programs.
Yep,
but she's not building her wealth the way she's telling you to do it. That's for sure. So
yeah, that's funny. But I'll be happy to show. You know, we now have 20 policies, and we have them for various reasons. We have them for our grandkids. We have a couple buy-sell ones for business purposes, and I'll be happy to show that I walk my talk. In fact, on my website, bankonyourself.com, I do show my policy statements. I show how they continue. I love the one where I show during the 2008 crash when the markets went down almost 50%. Most people, it was about 50% or so. And I show how it just kept going up and up and up. And I show my statement, and, you know, you can't make that stuff up, you know. I also, I'm always able to get capital when I need it. You know, Mark Twain is famous for saying that a banker is a fellow who lends you his umbrella when the sun is shining, but wants it back the minute it begins to rain. And isn't that the truth about them?
It seems to be.
and look around as to what's happening now, because I've been following this. I want to know how things are changing since the shutdown. And one of the things that's happening is that credit card companies are reducing limits without they don't have to give you much. They just say, by the way, we just reduced your $10,000 limit. It's now $3,000, because they don't want to take the risk. And so they're like, you think you have access to this capital, you think you have access to credit, but it turns out you don't. They're cutting back on home equity lines of credit. They're actually making it very difficult to take out a mortgage, even if you have, a job and all of that. They can change the rules any time that they want. Now, a life insurance policy is what's called a unilateral contract. And what that means is the company can't change any of the terms of the contract once it's issued unless you agree in writing to the changes.
Oh. So now going back to the instrument you were talking about, I know that you tell in the book that this has been going on for more than 150 years.
It's really closer to 200.
200, okay. Now, how come this has been effective but nobody's talking about it? How does someone listening today, how do they get started at least to investigate this and maybe even write questions so they know that they're on track and they're not being pigeonholed into an arena where it seems the insurance agent or company is making all the money and they come out on the other end thinking, well, maybe Susie Orman was right about these products and they're not worth anything. So,
well, I will tell you that after I first learned about this, I went to an insurance agent. I was referred to an insurance agent who swore up and down that he knew all about this. He'd been to several training sessions and a 2-day seminar on it, read several books about it. And he structured my husband and my policies, and they ended up having really bad issues happening a couple years later. And I called the company. I ended up getting to one of the top executives, and she said, our advisors, our insurance agents think they know what they're doing with this, but they don't. So what ended up happening is I was approached by a friend of mine who does a lot of training of life insurance agents and financial advisors. He has a totally separate company from me. I have no ownership interest in it whatsoever. And he agreed to start a training and vetting program for insurance agents who wanted to learn how to structure these policies properly, wanted to be able to use the very best companies and the very best products. And so now there's close to 200 of these Bank on Yourself authorized advisors, professionals that are trained on this concept, and they have to do a lot of, it's very hard to get into the program. About 1 out of 20 people get in who apply to it. The rest are rejected. So they're very picky about who they bring in, and then they do extensive training, testing, ongoing continuing education. And if you wanted a referral to one of those advisors, you could go to bankonyourself.com and just click on the button that says Request an Analysis. And that will get you a no obligation look at your situation and show you how you could benefit from a custom tailored program. All of the policies are customized. There's about 1,000 variables that go into each one, and because everybody's situation is different. So there's no arm twisting, no cost, no obligation. They'll be happy. I'm not a licensed financial advisor. I'm an educator, so I don't do that. But I can tell you that these guys know their stuff. They know how to do this. They're very comfortable with the idea that they're going to take a commission cut. What happens otherwise is you tell an advisor about this idea. The next thing you hear is, oh, you don't want to do that. They're just getting rich doing that. You want to do this instead, and they just steer you to a higher commission product.
Much like a stockbroker does, here's the great idea, this is going to make you money, and they keep moving you around because if they don't,
right.
They don't make their commissions. So.
Exactly. So I just think you'd be, and they're all over the country, and they're in Canada, and it's, you can actually see what your guaranteed bottom line numbers would be if you started a policy before you ever start it. You'll know. And then you know if it makes sense for you or not.
Exactly. Wow, a lot for people to consider. I know this day and age, too, what you're seeing a lot more of is people actually taking more responsibility for their finances, especially when it comes to investing. With all the information that's available, it's pretty amazing how people are beginning to learn how to day trade. And you kind of wonder why people didn't start doing that from the very beginning. And, of course, the easy answer to that argument is, well, nobody taught us any financial literacy. Yeah, well, you're old enough to actually learn these things.
Right. Right. You can set your mind to getting the information necessary to learn how to do it. But you did bring up something interesting. That's when you start going, all the alarm bells go out that there is a whole new resurgence in day trading. Because the markets are so volatile. People
right.
are trying to, and now you can do free trades, online,
Right.
So that's another thing I was reading about that's scary.
And it's funny, too, because you start to realize as you study this that these people who are called experts who went to school and got educated, you'll discover they're no smarter than you are, but it's your money that you're using, so you better get smart about it real fast.
You better, and that really was the problem, because the first thing we did is we tried to follow the conventional wisdom, my husband and myself, and that didn't work. And so then we thought, well, how some people are unlucky in love? Well, I guess we're just unlucky in investing. So we decided we would hire the experts, but not just any experts. Only the top experts, the most expensive ones. We looked at the rankings of the top 10 money managers and investment advisors in the country. We didn't care where they were located. We were going to find the best one. Well, we did. We picked one of the top. We interviewed them. We checked their references. We hired them. What ended up happening, and this was during the previous, not this last bull market that just ended, but the one before that, we ended up hiring 3 different top companies and investment advisors over a 10-year period, and all 3 of them ended up losing us money in what was, up till that time, the longest-running bull market in history. I mean, even a blindfolded monkey throwing darts could have done that.
Right. Wow. Huh.
And they were not cheap.
Right. That's crazy. You
I
know,
know.
it's crazy to realize just what's out there working against you, even in the guise of, no, I'm all for you, and you realize, well, I got duped. Well, yeah, well, you put yourself in that situation, and I always like to say on this program, we like to bring information for people to open doors, windows, whatever it is. But I still say it's still up to you to look into this more. Don't point your finger and say, well, they said, and this
Mhm.
is, and I did that and I got screwed. No, we said to take a look at this and take the next steps, learn how to ask questions, learn how to see what it is you're looking for. And there it is. And a lot of times this takes a little more due diligence than people think it does. As you said, we try to reach for that's quick, easy,
Yes.
gives us
Yes.
instant gratification.
Mhm.
And there's really that's rare. And I think also, as we were talking about investing, people look at it the same way. They look for that kill.
Yep.
Movies are loaded with this kind of nonsense. But the fact is, most investors that have made money usually have done it just steady and consistently.
Mm. Yes, and they also have to avoid being human, because humans, and even the experts are humans, and they are guilty of buying and selling at the wrong time, and they do it over and over again. By the way, that's another myth about this whole, if you invest for the long term, you can get these kinds of returns. So when they show like mutual fund returns, for a specific period of time, it assumes that you bought the fund on the first day of that period, and you held on to it until the very last day of that period, whatever the period is, 1 year, 5 years, 10 years, 20 years. But almost no one is holding on to funds, including the experts, for that long. The average time, I'm sure it's less than it was the last I checked, but it's like 3 years. People only hold these investments for 3 years, so they never get the long-term results that they, advertise. Nobody's getting them, not even the experts, because they are also turning over their investments.
So, Pamela, as it's been wonderful to have you on the program, let's go ahead then and take people through the steps moving forward of a couple of good right questions to ask, whether it's a financial advisor or they decide to go to an agent, and how they can really work this properly.
Okay, well, I would say if you're working with someone, ask them the question, can you tell me what my retirement account will be on the day I wanted to tap into it? And they can't. You have to make the decision. Is that the kind of retirement planning you want to be doing? I would also ask them, why am I investing in a tax-deferred account? Can you tell me what my tax rate will be in 20 years? And then I would ask them, what direction do you think tax rates will be going in 20 years? If they tell you, don't worry about it, you're going to be retiring in a lower tax bracket, then I would probably run the other way, because the only way you're going to retire in a low tax bracket at this point is if you're dead but broke. I would then maybe ask them if they are aware, if they could tell you what high cash value dividend paying whole life insurance is. Not whole life, and don't ask them about whole life. Ask them, can they tell you what high cash value dividend paying whole life insurance is, and do they know what the two riders are that you need to add in order to make the cash value grow very fast, much faster than the traditional policies. If they don't know the answers to those questions, it will take them at least 1 year to become proficient in designing policies the right way and knowing how to do that. So if you're having trouble finding one and you want one that's been trained and vetted, you can go to bankonyourself.com and request a free analysis. If you would just like more information, or you want my book, Rescue Your Retirement, about the wealth-killing traps of 401ks, IRAs, and Roth plans, well, you can get that for free at sendthefreebook.com. That's sendthefreebook.com. And I would really ask yourself if you want to be responsible for your own financial future, or if you're willing to give up responsibility and allow other people to do it for you who don't have the same vested interests in your financial success that you do. You only get one chance to do it. You got to get it right. We have an awful lot of boomers and people who are pre-retirees right now, or even who have just recently retired, who may not have their retirement plan, according to what we're reading now, is moving in with their kids. If you don't want to do that, you've got to do something different. Isn't the definition of insanity continuing to do the same things, the same way, with an expectation of different results?
Absolutely. Wow. Pretty amazing stuff, Pamela, as always, and I'm glad you gave out your website for our listeners out there. Is there any parting thoughts that you have for people?
I would say that a lot of people are feeling pretty hopeless right now. They just don't know if there is help for them. They're also concerned, is it too late for me? And I want to tell you, in most cases, it's not too late. Don't make the mistake, though, of putting it off any longer. Make a change. Do something different. Do some things that will bring you financial security instead of keeping you awake at night wondering how low the market's going to go, how you're going to pay for this, that, or the other thing because your stimulus or your unemployment check is late. That's a recipe for an early grave.
No doubt about that, especially when you leave up all of this for somebody else to take care of, and then you become the victim when it doesn't work out the way they told you it would, or you believed it would work.
Exactly.
And it's very encouraging too that if you just start now, whatever that starting point is to realize that you can actually accelerate it to be faster, but it depends on what you're willing to do. And one encouraging thing to bring up would be that of Anthony Robbins, and it was something I learned early in my career in radio. Is I wanted to become better. And he said the key word is frequency. Frequency can get you there as fast or as slow as you want it to, but that's the key. So I realized, okay, well, can I become really good in a short period of time doing one hour segment a day, 3 days a week? Or would I become better if I did three 3-hour segments or 3 1-hour segments 5 days a week? Which one would accelerate me there faster? And there you go. I mean, when you think about that key concept, and it's the same thing here with financial literacy. How much time do you commit in a day? And everybody, it's funny how until this pandemic happened, would say, I just don't have the time. Well, what do you have right now?
Yeah, exactly. You got lots of time.
Everybody has time. You just have to make the decision to make sure that is something that you find necessary if possible. And that you require yourself, you demand yourself of. Financial literacy, day trading, can you learn how to be good at this in 6 months? Probably, but what is your frequency? How often are you hitting it and trying to learn, for instance, your financial language?
Right.
Things like that. And that's exactly, to a degree, what you were saying earlier, that for a lot of us it's not too late, but it's still up to when are you going to get started. I think the key thing to let people know is what is the frequency, the commitment you're willing to make to do this, and you'll be surprised. And I think people become more astounded to realize that they are much greater than they thought they were.
They are absolutely capable of so much. We are all capable of so much more than we thought we were. And just what you were just saying just made me think of, reminded me of an old African proverb that the best time to plant a tree was 20 years ago. The second best time is today.
Absolutely. Either way, it's going to grow if you give it that opportunity, for instance. Well, Pamela, thank you again for being on the program today. And go ahead and give out your website one more time for our listeners.
Sure. You actually, if you want to go just to bankonyourself.com, at the very top, there's a place where, well, if you're on desktop anyway, you could get to it on mobile as well, but there is a link to buy the free book, get the book for free, the Rescue Your Retirement book. There's also a free special report, or you can request an analysis and referral to one of the 200 advisors in the U.S. and Canada with advanced training on the concept.
Well, there you go. Pamela, thank you for being on the program today. It's been a pleasure, and stay well.
My pleasure as well, Daniel, and you have a lot of great insights that you give your listeners, and they're very lucky to have you.
Well,
I'm
I
glad
appreciate
that you've been practicing frequency.
Absolutely. And like I said, you could be as good or you can be as moderate as you decide to be, and it's really amazing. To me, I think that was the greatest piece of advice I could get when it comes.
Yeah.
And I wanted to bring that up because it allows people to see, yeah, it really is possible. What is my commitment? Do I give it 5 minutes a day? It's like Jim Rohn says when it comes to building your knowledge base. How are you spending your money? Are you spending, your $30, for instance, on cookies, or do you spend it on books? It goes to show however you decide to spend your money shows you just how your life is working.
Yeah, it does.
So, pretty crazy stuff. Thanks again, Pamela, for being on the program today.
My pleasure, Daniel. You stay safe, too.
Stay
healthy.
Thank you. We want to thank you, the listeners out there, for tuning in. You can discover more at beyond50radio.com. That is the number 50. We do encourage you to sign up for our weekly e-newsletter and stay up to date with what's going on in the world of Beyond 50 as well as our upcoming shows. I'm Daniel Davis. Thanks for joining us. This is the Beyond 50 radio program, and remember, live your day past halfway.